The Federal Reserve has announced its final interest rate decision for the year. On Wednesday, the central bank cut its benchmark rate by a quarter percentage point to a range of 4.25% to 4.5%. These numbers are still high compared to 2022, when the federal funds rate was between 0 and 0.25%. The Fed's decision to move forward with its third consecutive cut comes as inflation slowly cools here in the U.S. On Wednesday, Federal Reserve Chair Jerome Powell provided updated guidance for future rate cuts.
And our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026.
Powell signaled the Fed will only make 2 more rate cuts next year, and this worried investors and caused the Dow Jones, NASDAQ, and S&P 500 to plummet Wednesday afternoon. Joining us now is CBS News contributor Javier David. He's also the business editor at the Dallas Morning News. So, Javier, the Fed cut rates by a quarter percentage point. This was expected. How, first, will this affect Americans directly?
It's not great news if you wanted to see lower costs on your credit card bills, on auto loans, and particularly mortgage rates. The caution that the Federal Reserve Chairman expressed this afternoon has been sort of materialized in their projections for next year. It means they're going to be considerably less aggressive on Fed cuts than they thought they were going to be a couple of months ago. And his words were specifically, today was a close call. From here, it's a new phase, and we're going to be cautious about further cuts. So caution means a lot of the borrowing costs that consumers and businesses were kind of hoping for relief are just not going to be as favorable as they thought it was going to be several months ago.
So I want to get back to that caution and the market reaction in a second, but some experts had been saying current economic conditions didn't call for a rate cut at all. Why?
That's a very good point, and it's one that we're all still debating. The reason why primarily is because inflation has just proven itself to be a lot more resilient and sticky than we thought it was going to be. Now we are, at the end of the year, we kind of thought that we'd be closer to 2%, which is the magic number that the Fed sort of looks at in order to set policy, and is like, that's their target. We're still really hovering dangerously close to 3%. And the last inflation data that we got was really surprising. It was as expected, but unfortunately higher than like what you think it would be in this part of the cycle. So that's really the telling. That's basically the tail of the tape. It really has to do with the fact that prices are still elevated in a way that makes Federal Reserve uncomfortable, and it makes consumers just kind of miserable whenever they go to the grocery store or buy all of the things that they need for their lives.
So why is the market reacting the way it is today?
Well, because it's clear that the Federal Reserve's this caution that he signaled means that less rate cuts, and markets and investors love rate cuts. They love easy money. And
but Javier, it was widely expected that 2025 wasn't going to see as many cuts.
Well, you have a lot of things happening in 2025. You got a new administration coming in, and they're putting out a lot of policies that are kind of stimulative on the tax cut front, and the lots of uncertainty surrounding what the president-elect will do with tariffs. And those are, unfortunately, things that will put upward pressure on prices. So you have all of these countervailing forces, and the market's trying to suss it all out, but it really doesn't help when the Federal Reserve Chairman comes out and states pretty plaintively that we're in this new phase, and there may just very well money may not be as easy as we thought it was going to be.
Gotcha. All right, Javier David, always good to see you. Thank you.
Sure.